all of the Asian markets now barring just the Hang Seng, which are trading in the green.
We must close on the Bank Nifty above 44,500 levels.
Kotak Mahindra Bank is in focus because Canada Pension Fund is looking to sell 1.6% stake via block deal.
IT staffing business and degree apprenticeship business both have had very strong headwinds.
This will be something like, couple maybe BSE and NSE or couple Ola and Uber. So that don't make a real business case.
Quiet with a positive bias, so 18,650 is something that's holding.
Some 1/3 of the market will do significantly better than the market.
Yesterday, in a large bulk deal, actually picked up almost 0.8% of the total equity of the company.
Growth is being supported both by cyclical and structural factors.
The COC today in its meeting is going to name a new resolution professional, is what we've been given to understand.
Banks are the biggest headline today. Otherwise, the market is a little listless.
We see probably 100 times potential upside for us from the current levels.
Mid-cap index is in the red after outperforming for most part of the day today.
You're with us here on a fresh new edition of Closing Bell. We are coming to you live from the CNBC-TV18 Motilal studios. Those were visuals of our coverage for the day so far. I'm Prashant. With me, my colleagues Rima and Surabhi here in the studios. And Nigel is joining us from the newsroom floor as always. Guys, hi, good afternoon. Things are grinding lower, aren't they? And they've been doing so from the word go this morning. We're down 70 points now, 75 points, but it's been slow. So it's not rapid, not a big decline. And it's coming through in spades, but 1/3% lower is what we have. The big, if you want to talk about the Nifty, the big supports, the meaningful support zone is some distance away still. That only comes in at about 18,431 to 18,464. So that's, as I said, some distance away. One is the swing low, the other is 20 days of yesterday's close. Bank Nifty is doing a little better. It's more or less flat. Large banks like Axis, Indus and ICICI are up. Mid-caps and small caps are trading flat. Advanced decline, the last I checked, was about 1:1. And you've got a global scene which is pretty quiet. I mean, there's no data, nothing. You won't hear from the Fed or Fed officials. There is the meeting next week, later in the middle of the week, that is. So not very much to expect from that market as well. In terms of data, the big one is the CPI. That's going to be the last one before the Fed decision really comes through. But there is a little bit of profit taking, like yesterday, what we are seeing. Nothing dramatic, but a little bit of red on the screen. Rima.
Hi, but the high this week on the Nifty was 18,777, which we hit yesterday before the fall, before the fall began. So from that level, the Nifty has given up close to about 200 points in this grind down yesterday after the hawkish RBI policy meet and in today's fall. So courtesy, this week, the Nifty's actually done nothing. The Nifty's just up close to about 0.1%, though the mid-caps have fared a little better with a gain of about 0.5%. The index which stands out is the CPSE index, the basket of the government-owned, central-owned, companies. So the Nifty CPSE index is up 2.5%. Autos have done well earlier this week. They went on to hit record high levels. But IT, that EPAM guidance, has really shaken many of these frontline IT names. So Tech Mahindra has slipped 5%. TCS and Infosys are down close to about 2 to 3%. So once again, demand concerns are on the rise. On the mid-cap end of trade, there are quite a few stocks which catch your attention. So India Cements has moved up on pretty large volumes. HAL up 6% today, up 18% so far this week. Tata Communication has rebounded after yesterday's fall. And on the losing side, you've got HDFC Life, ICICI Pru on the Macquarie downgrade, and Voltas. It's fallen about 2.5%, but from its 52-week high, the stock is down 26%. So at a time when the mid-cap index is flirting with all-time high levels, Voltas continues to grind lower, given the market share concerns, etc. And this whole sweltering heat doesn't seem to have helped, Voltas's room air conditioning sales, because at least it's not reflecting in the stock.
Speaking of sweltering heat, I think heat is on our mind, because the word that I was constantly thinking of looking at the market today is wilting. That's what the Nifty seems to be doing, like literally wilting away. Prashant, I mean, take your point, it's not much of a decline, but I guess the issue here is that a lot of the Asian markets did better than us. We had a decent handover from Wall Street. If you look at the Nikkei today, or you look at the the Hong Kong markets, the Kospi, a lot of those markets have managed to have gains, whereas we have seen a more or less a consistent decline. Today, barring that little bit of volatility in the beginning, the first 1 hour where there was a bit of a fight back from the bulls, After that, it seems like the bulls packed up and decided to, get to the exit door, perhaps for an early weekend. Right now, we are very close to the lows. Also, the nature of the fall. This is not 2-3 major stocks. This is the whole market. You're seeing last little shade of green on the Bank Nifty. That's because of just 1 or 2 banking stocks. You've got your IndusInd on the upside, for instance. But other than that, the Bank Nifty is at the day's low, IT selling, everything is selling. On the Nifty, by the way, there are only 2 stocks that are up more than 1%. Everything else is either negative or flat. The 2 up stocks that I'm talking about are IndusInd and Axis. L&T has been pretty consistent from the morning. There you go, L&T. But look at the other side. Lots of those big boys dragging their feet. So, Nigel, I guess the level that Rima spoke of, that 18,777 yesterday's high, 100 points from the lifetime highs, but it'll have to wait. Not this week, I guess.
Well, that's right. I think 18,520 on the downside. That's a crucial support, before we get to the DMAs, the 20 DMA and the like. So 18,520, if we hold about those levels, I think you're pretty much fine. A bit of a pause, a bit of a pullback before we resume the up move. So just keep an eye out on that mark. The problem is the Nifty Bank that was doing quite well. It was up close to 200 points. That as well has come off a little bit. And from a more number of stocks advancing, now we have a larger number of stocks that are declining. So the crisscross lines will tell you the picture out there. How do you position yourself, though, in the final hour of trade? That's the big question. To help us out with that, Kush Bora joins us on the show. Hi, Kush. Good afternoon. Well, we've just got 60 minutes before we get into the weekend, and we're all looking forward to that. But how do you approach trade right now?
Hi, Nigel. First up, thank you for having me on the show. As Surabhi was saying, the weekend seems to have begun a lot early for the bulls anyway, right? And this is what we mean by buy on dips. And, this is the dip that we were talking about in the morning as well when we spoke. So for me, just putting things in context, if we see from expiry to expiry, from the last expiry to the one that, just, got done with yesterday, only IT index was the one that has ended in red. The rest all, ended in green. So the rally is already there. It's broad based. So, there's some profit taking on the table, not an issue at all. So I still see this as a buy on dips market. For me, the threshold levels on the Nifty will be 18,500 and 18,450 zones. Once they're taken out, we'll probably consider a change of trend, but up until then, I'll remain a buyer. As far as Bank Nifty goes, well, it's, fighting tooth and nail to hold on to its, 20-day moving average for the last 5-7 sessions. Has done successfully, and the puts, the put base at 44,000 does suggest that, he'll probably do that. He'll continue to hold on. So 43,600 is where my, threshold is on the Bank Nifty. Until these levels are held, I will continue to remain a buyer. But given the event-heavy week that we have, the CPI, WPI data in India, and the Fed interest rate decision, later, I would perhaps keep my positions light, but still look for buying opportunities.
Look for buying opportunities. But light. I mean, I think that makes sense. Sorry, Kush, you laid out your individual calls, trades?
Haven't yet. The 2 calls that I have are from the spaces that are doing well. One is the capital goods space, and the other is defense. So from the capital goods space, I have the I have AI engineering. The stock is doing well. It's rebounding quite smartly from the lows. So 3250 and 3300. These are my targets. 3150 is where I would place my stop loss. From the defense space, I have Astra Micro. This stock has been, gaining from strength to strength for the last 10 to 15 sessions, irrespective of the market condition. Looks, ripe for a breakout. So 380 and 400 would be my targets on this. 355 is where I would place my stop loss.
Okay, thank you very much for that. Let's get talking about D-Mart or Avenue Supermarts. Now, that's in focus on the back of a brokerage update. The stock is surged close to about 3%. We've got Mangalam joining in. Mangalam, it's Motilal Oswal, which has upgraded D-Mart. Can you tell us their rationale?
Well, yes, Motilal Oswal has upgraded D-Mart, but the bigger point is that D-Mart's now back in fashion after this upgrade. Perhaps that's the trigger that the street needed, because if you just take a look at it, Motilal Oswal targets the SSSG for the company, the same store sales growth, to improve from FY24, and they say that moderating valuations provide a decent entry point. So let's take a look back at D-Mart's journey. I mean, when it started to, when it listed to, for the next 3 years thereafter, it rallied about 7 times, and thereafter, for the next 3 years, it did practically nothing. It's down about 21% in the last 3 years, and from the record high itself, it's down about 32%. But that's about the stock performance. Fundamentally, in the last 3 years or so, the company's added almost 150 stores post-pandemic. That's nearly more than 50% of their overall store strength. And as a result of which, the revenues of the company too, pre-pandemic, were close to around 25,000 odd crores. Then was a mild dip on account of the pandemic. And now, as of the last financial year, they've almost doubled, close to around 42,300 crores, 42,850 crores on the top line itself. And this is important mainly because 50% of their stores were added in the last 3 to 4 years. And Motilal Oswal says that the newer stores which are added, which are larger, will continue to grow in peak beyond the 3 to 4 years mark as well. And that's what gives them a rationale as well. While the newer stores are larger, they've had a bearing on a couple of factors. One, the sales per square feet has come down from pre-pandemic levels. And secondly, higher inflation has reduced the contribution coming in from general merchandise and apparel. So that has impacted their gross margins. But despite that, DMart's EBITDA margins are, stable at around 8.5% odd. And they've scaled up DMart Ready, which is their e-commerce business as well, to a quarterly run rate of almost 250 odd crores. As far as the valuations are concerned, pre-pandemic, the 5-year average was close to around 60 times EV to EBITDA. Currently, after the correction, is 36 times, and Motilal Oswal believes that the fair value would be around 40 times itself. So the key to track would be recovery in same-store sales growth, improvement in their revenue mix, scaling up of their e-commerce business, and the optionality that they've brought their pharmaceutical business in the DMart stores as well is something that we'll be watching out for. Any recovery, late recovery in growth and increased competition from larger e-com and modern retail players could delay the up move that we'll see in perhaps DMart.
Okay, all right, Mangalam, thanks very much for that interesting take there. Prakash Devan is now joining us for some thoughts on the market. Prakash, hi, good afternoon. Last hour of the week in terms of trading. I just want to start by getting your thoughts. You're someone who tracks a lot of mid caps, small caps. I don't reckon the question whether one should take profits in mid caps is justified, because then the question is profits and what, right? Just like you can't buy mid caps, or maybe you can buy a mid cap fund, because it's so varied, so many different sectors, subsectors, smaller segments, etc. But can we say something about the broader rally and the approach one should have after this? I was just looking at the rally in the mid and small cap space. Started from late March, right? 29th of March was the low, and I was looking at the NSE 500 group of companies. Only 40 out of 500 stocks are even lower, and I counted about 15 stocks out of these 500 which are up over 50%. If I look at everything which is trading on the NSE, the numbers I'm assuming would be even starker, because the rallies happen in very small stocks as well, which fall outside the 500 group. But what's your sense, Prakash, this group and the approach, mentally the approach one should have now?
Yeah, so very, Prashant, very interesting set of statistics that you put forth. It's visible in the kind of texture of the market. And just to give you, and just to add to what you mentioned, while the Nifty's moved from 18,600 all the way down, come back full circle, there are lots of stocks which are still on the Nifty constitute, which are down 30%, 40%, 20%. So you've got an Asian Paint which is minus 15%, and Infosys which is close to 24% down. So what it's telling us is that while the Nifty's come back to skirting around the new highs, a lot of stocks have lost ground. On the other side, what has absorbed all the capital allocation that's come into the markets? It's the broader markets. Now, why that's happened is very clear. Post-December, when the broader market started slipping down very rapidly and probably, making a low end of March, you actually lost a lot of ground and a lot of enthusiasm. And after that, all the smart money that's been coming in has been coming into businesses which have continued to clock very decent results, whether it's December or March, probably in anticipation of the next quarter, June end numbers. So, the market has seen money come in not from retail in general, but it's a lot of the HNI money that's coming, Prashant. And that's usually very, very pointed, very specific. So I think it's primarily because of the kind of money, because of the nature of allocation that's coming. And how do you approach this market further? I think you'll be best placed to allocate money to small cap funds or mid cap funds, because you have a diversification. You don't need to time the entry exits and some of the counters. And it's a tricky market, Prashant. Let's face it. I mean, volatility is absolutely stunning. I mean, I've not seen this kind of volatility and uncertainty in markets in the last so many years. So it's not going to be easy for people to navigate through individual stock allocation, but it's better to go through the fund route. Unfortunately, we don't have a very major smattering of ETFs in that segment, in the small cap, micro cap. But wherever actively managed funds have done well and stuck to the knitting of sorts, focused on particular general themes, I think investors will be will be better off doing that.
All right, Prakash, request you to stay with us. So the stock of the last 24 hours has to be IEX. The stock is down close to around 8.5–9% today as well. Yesterday as well, it got smacked in the face. This post, proposal coming in from the Power Ministry to include, coupling. And that would mean that it will lose its power as an exchange and maybe start functioning like a broker. Well, it's not yet implemented. But why is the street wary? We have Vivek who joins us to tell us exactly that. Vivek.
Well, absolutely right. It's been a very rough couple of trading sessions for IEX. Stock down almost over 16 to 17% if you take into account yesterday as well as today's move. Now, what's actually happened is that, like you rightly mentioned, the Ministry of Power has gone ahead and directed CERC to undertake the process of market coupling, which basically indicates that now there could be a third party independent entity that would do the process of order matching, and the price discovery process would happen outside of the exchanges. So what's actually happened is that we have a couple of brokerages that have come ahead and reacted expectedly. They are quite wary about how the prospects of IEX now stack up against this impending regulation regime that could come in. So what they're saying is that UBS in fact is saying they've maintained a buy stance. They believe that the stock price reaction could be a bit of an overreaction at this point of time. They're saying that they're looking at several potential scenarios despite there being no mention of MBED. What they're saying is that market coupling along with MBED will actually increase the overall volumes of short-term power exchanges by almost 12 to 15 times. Along with that, what they're saying is that market coupling could be seen in selective segments, like what they're saying is that it could happen in the green energy or the inter-regional transmission. And lastly, the worst case scenario, what they're saying is that a simple market coupling with no change to the existing structure, which impacts operations of all of the power exchanges. So what they end with, they say that the process is right now in a very nascent stage, and they expect it to target broader power market development. On the other hand, Antique has immediately gone ahead and downgraded the stock to a sell. They believe that incentives by other competitive exchanges like HPX and PXIL will start eating into the market share of IEX, and which is why they've gone ahead and downgraded the stock. We spoke to the management of IEX. At this point of time, they believe that the market may have misinterpreted, and they say that they can continue to grow volumes at 15% for the year. HPX, on the other hand, whom we also spoke to, they sounded very enthusiastic. They believe that it's a long pending move. It's been a long ask from the competitive exchanges, and they believe they can significantly increase market share in the coming days.
I don't understand this market coupling, what we are now talking about, that different exchanges will be coupled through this. This will be something like, couple maybe BSE and NSE, or couple Ola and Uber. So that don't make a real business case. I mean, it will kill basically innovation and competition in the sector. So I don't think the interpretation of the market coupling, which is now floating from the last one day, is the right interpretation. They feel that if we should go ahead with this, then they will issue a consultation paper. Everybody will have opportunity to give their submissions, comments. We will also have opportunity to give our comments. Earlier, our market share used to be almost about 94–95%, but in the last 1 year, it is now almost about 88–89%.
The language that has been used in the circular which came out, it is abundantly clear that it has to be implemented. It remains with an honorable CERC to frame the necessary regulations and the framework in which this mechanism would operate. There's definitely a lot to do. It would definitely take 4 to 5 months at the very least to implement this reform. It has been long pending. Not that much discussion has not happened on this subject. There's been a lot of discussion that has happened in the past. So the market is well prepared for this kind of a change. The only thing is the regulatory framework has to be there in place. As of now, in the day-ahead market segment, IEX had the complete monopoly. Going forward, that monopoly definitely goes away. Okay, so coupling becomes important if other exchanges have to get a market share in that. So this is true for all collective segments. So our market share was 0 last year. We started operations in July 2022, And therefore, all the volume that we have gained is from the existing exchanges. Okay, so from that perspective, the number that you see falling for IEX, there is some contribution that we have made, and there's some contribution that the other exchange also there in the market has made. Okay, there is a general movement away from that DAM segment to the planned segments of the market where entities have started procuring more in monthly, weekly, and the daily segments. That also has led to the fall in the DAM volumes, and that basically hurts obviously the dominant market player.
All right, so there you heard it. Both the players, the large incumbent dominant player, that's IEX, and some of the newer rivals like HPX that have also set up operations in the last 1 year or so. Prakash, now this IEX story, I mean, obviously it's far more interesting now in the last 24 hours. But anyway, this is a stock that's been going through a long derating, right? It's done nothing in the last 1 year. It's declined some 30-35%. So I don't know. I mean, would you right now catch the falling knife? Or is it a complete steer clear for you?
So, Shami, good afternoon. Yeah, the answer to your question is in the question itself. If it were to be termed as a falling knife, absolutely you're not trying to catch it. And my worry is not just, the interpretation of this coupling-related regulatory announcement, but it's more to do with the kind of competitive intensity that seems to be growing. I mean, that's been happening for a while now. And as you heard the HPX representative talking about, how they're getting market share at the cost of the dominant players' market share. So it's very clear you were the only boy in town doing this. Now you've got other boys coming in. It's going to be definitely a little bit of a reset. Till the overall market starts growing, it's going to be an impact. And that's what I think some of the brokerages are also anticipating. So I used to have a very positive view on the stock, but it's gone 5x, 6x from there on. And now it's come back after the split where it is. But I would not definitely look at it with the same thing. The entire sector is going through a re-rating on the generation and distribution side. So there's far more better opportunities there rather than this small pocket of exchanges, which is still a very rapidly evolving environment. So I would stick to the boring power generators, distributors, and look at how some of them are done. The NTPCs of the world, the BALs of the world. I mean, there's lots happening there. And it's a great sector to look at for the next year and a half.
Even now, BHEL has moved to the high point of the day. Power Grid has rallied close to about 1.5%. So that's a space which is seeing a lot of interest. Do stay on, Prakash. Need to slip into a break. We'll come back on the other side with our Alpha Manager for the day, Shibani Sarkar Kurian of Kotak Mahindra AMC. Welcome back. Last 35 minutes for the week to come to a close. The Nifty is down 60 points, a cut of 0.3%, while the sensex is lower by 0.3%. A pocket of weakness today are the life insurance company, and this is after brokerage firm Macquarie has downgraded the stocks. Surbhi is here with the details. Surbhi.
Hi, so Macquarie has put out a very cautious outlook on the life insurance space. Now, they've downgraded the top 3 private insurance players to neutral rating from outperform rating. For HDFC Life, the target price is now 556 from 655 earlier. For ICICI Pru, it's at 486. And for SBI Life, it's 1306 from 1580 rupees earlier. Now, they say they remain concerned on the longer term growth aspects due to the regulatory overhang. They see the premium growth being affected due to the changes in the tax regulations. They expect the premium growth to be affected to the tune of 15 to 20% due to change in the ATC deductions and close to 2 to 10% due to the loss of high ticket size policies. They even say in the last 5 years, the value of new business has grown at a compounded rate of 17 to 30% and have driven record high VNB margins. But they think the margins have now more or less peaked and they don't expect margins to support the value of new business growing forward, especially in the next 3 years. So they forecast the lower VNB CAGR at close to 9 to 15% versus 16 to 22% earlier. And for FY25 specifically, they have cut the VNB estimates by anywhere between 2 to 6%. So they say unless the growth picks up meaningfully, the sector will lag in the near term.
Got that. Thanks very much, Surbhi, for all the details. So, well, some concerns being raised by Macquarie over there. Prakash, your thoughts on life insurers? And I missed asking this earlier. The DMart debate that Mangalam was talking about at the start of the show, that was pretty interesting, with Motilal saying that this is a good time to buy, stocks not run up. So, life insurers and DMart. Quick take.
Okay, so let me take DMart because chronologically that came first. I think the Motilal report just talks about a 25% upside on the EBITDA basis, because it's more to do with it moving from 36 to 40. So fair enough, 4,000 going to 3,000 going to 4,000 plus whereabout. Interestingly, what they've done is they've been able to maintain margins and probably chosen a bit, they've been a bit selective in terms of which pockets they want to grow. They've let go of market share to the likes of Zudio and Trent and some of the other competition. But that's fine. I think it's got its product mix right. It's got the price points right, the segment that it's addressing. And if it starts scaling up, you'll get it. But I've always found DMart to be expensive, so it's not a recommendation to buy even for this upside. But it's a great business that will continue to do well for the people who have invested into at lower levels. But it probably is too pricey at this point. On life insurance, if Macquarie has its say in terms of bringing these prices down and saying it's neutral on the view is neutral on these companies, I would definitely want to buy these and create a basket of all the top 3 private insurers for the simple reason the growth story in India is a secular story based on growth in participation, in penetration, and it's not a margin game. So, as more and more people get covered and the digitization impact is now making it much more rapid. And there have been a little bit of, upsets. We saw some viral video on a private sector bank pushing insurance to its team. And, there'll always be these blips here and there. But I think the growth story is very clearly long-term and intact. And any dip would probably be an opportunity for people who have not yet added this to the portfolio in terms of a long-term coffee can kind of outlook for the next 10, 12 years.
Okay, well, Prakash, it's a good chat as always. Have a fantastic weekend. I hope you're catching up on the big tennis game later today. I don't know if you're a fan, but I plan to. Thanks very much for being here as always. Shibani Sarkar-Kurian is now joining us. She's a Senior Executive Vice President and Head Equity Research at Kotak Mahindra Asset Management Company. Shibani, good to have you with us here. Great speaking with you this Friday afternoon. The funds are doing fantastic, right? I mean, I was looking at not mutual fund returns, but PMS returns. Monthly, we're talking about early double digits for 1 month, and this is now true for the last 2 months or so. I don't know what kind of returns your small cap, mid cap funds, etc. are delivering, but where are we at now in this re-rating cycle for that part of the market, mid caps and small caps? Are we closer to the highs, or you think there's still a long distance to go?
Yeah, hi Prashant. Good afternoon. So when you look at markets, Indian markets by and large have been far more resilient than what was earlier anticipated. So when we started off this calendar year, our markets were underperforming. However, a lot of that underperformance vis-a-vis the emerging market pack has been erased in the last couple of months. And as you rightly pointed out, the mid and small cap basket has outperformed in this sort of an environment. Two key factors have been driving markets in India. One, on the macro front, I think India clearly stands out, not just on growth, but also now in terms of an external sector as well as monetary policy, where our real interest rates are positive, whereas developed markets, you are still seeing a fairly loose monetary policy. So there is room from that perspective. The second factor, I think, has been the earnings season, and the earnings season turned out to be fairly good in the sense that there were no major disappointments, and earnings delivery was largely in line with estimates. So I think that has been very crucial in terms of the way the markets have moved. Now, when you look at mid caps as well as small caps, when you look at mid cap valuations vis-a-vis large caps, and if you look at the mid cap index versus Nifty over the long period, in terms of valuations, the mid cap index is still trading at above long-term average levels. While the small cap index, while I don't know whether it's a very comparable number over a long period of time, small cap has come closer to long-term average levels. So from here on, we believe that delivery of earnings for the market is going to be extremely crucial. Market valuations at a headline level are fair value range, and we've come back to long-term average multiples, and even our excess vis-a-vis the emerging market pack has also been erased. So market valuations are fair, but for markets to move up from here on, earnings has to come through. If you look at consensus earnings estimates for both FY24 and 25, consensus is still building in about 15 to 17, 18% earnings growth over the next 2 years. So that's our view, that markets are at fair value range right now. Slight preference in this market for large caps over mid and small caps.
Shibani, afternoon. You know, we always end up talking about the big sectors like banks, and we know your view there. You've been bullish on the banking space, on IT. I want to go a little deeper into other sectors, say something like textiles, oil marketing companies, gas companies, liquor companies, tires. There are so many other themes. Can you tell us some of these other themes that you're bullish on and why? Where structurally there are tailwinds.
Yeah, so you've mentioned a lot of sectors which are fairly diverse in nature. So when you look at our portfolios, so let's start maybe with the overall portfolio construct. What we have really done is looked at sectors where earnings growth is visible, and what we believe is that the domestic facing sectors are seeing far more visibility on earnings over the next couple of years. So in that space, banks, as you rightly pointed out, we've been positive on. But within the other segments, auto ancillaries, industrial, capital goods and cement have been segments where we have been positive on. Cement, for example, if you look at current structure of the industry, one, you have seen market share shifts and consolidation. Secondly, volume growth in terms of delivery has been extremely strong, where both infra and housing has contributed to the growth. Thirdly, if you look at input cost pressures have come off sharply, and from next quarter onwards, you should start seeing margins expand and therefore overall profitability expand. So that's been one segment we've been positive on. On the oil and gas space, of course, that's a sector which has been very cyclical and difficult to predict. But structurally, the gas utility plays are something that we believe from the overall fuel perspective seems to be where we have placed our bets on, and therefore the gas segment is where we have been positive on. Apart from that, real estate and home building have been some other spaces, specifically the home building space. So cement we spoke about, so other segments such as pipes, ceramics, tiles, plywood, these are some of the other areas where we are positive on in our portfolios.
Okay, that's quite a list. Shibani, hi, good afternoon. Surabhi here. Gives us plenty of food for thought. Let me just recap. So banks, of course, you mentioned capital goods, cement, related space would be home building, pipe companies, gas utilities. Did I also hear real estate? As in, do you have a house call which is positive on realty per se as well?
So we've been positive on the real estate space. Of course, stocks have moved up quite sharply, and therefore valuations have to be taken into account. But structurally, when you look at the real estate sector, this sector has been, again, a beneficiary of consolidation where market share has clearly moved towards the larger organized developers. Policy changes have also helped significantly from that perspective. The interest rate cycle, when it was benign, affordability moving up also resulted in a lot of demand coming through, and therefore the excess supply that was there has been largely absorbed and inventory levels have come off. Of course, in this segment, what we have also seen is that premium segment has done better and therefore demand has been strong. I think right now, given the valuations, what we have seen is while the developer base or the real estate pack has moved up, the home building segment has lagged. However, once you start seeing a lot of these sales translate into, people starting to move into their houses, a lot of the home building sector and demand should also start to pick up. And that's where we believe there is an opportunity set at current valuations. So what we are really doing across our portfolios is looking at opportunities in terms of growth earnings, but very mindful of valuations in the current market.
Yeah, but have to grudgingly pay higher multiples, right, if you want to buy, and no choice.
Yeah, so in some pockets, yes, but we are not in the camp that you will buy growth at any price. What we try to do is growth at reasonable price, but yes, at some points you might have to grudgingly pay slightly higher valuations.
Any thoughts on, we had the management of Angel earlier. Angel One, stock's done very well actually. This going down the financialization theme, that's been a very powerful and I don't want to say secular because it's just been a few years. Maybe it will be secular. But do you own any of them? What segment there?
So I think you're right. The financialization theme is actually secular in nature. So, of course, in a secular theme, you may see some ups and downs here and there. But again, in this segment, while I don't want to specifically talk about a particular stock, but what we have really seen is, again, market share shifts have been extremely stark, right? So people or players who have been able to innovate, have been able to incorporate technology in terms of their overall business strategies, have been able to gain market share. And that is what is reflective in some of the names. Overall, if you look at our portfolios and the segment, financialization of savings is something that we think will continue. Of course, market movements here and there will impact some of these players, but as a structural theme, this is something that should continue. And those players who have been able to gain market share in the segment should be better off in this particular space in the broking industry. But a lot of disruption has already taken place.
Oh, yes, absolutely. It has. So many different shifting trends. Yeah, I think Angel One was telling us that a lot of their transactions, as high as I think 90%, are happening on the digital mode, on the mobile, on the app. So we live in a new world, absolutely. Thank you very much for joining in. You have a great weekend, Shibani, and we look forward to our next conversation. Well, quick break with the news. The market continues to kind of struggle along. 64 points now down on the Nifty. That's the story. We'll take that break and come back with all the chatter in dealing rooms today. Nimesh joins in with the street chatter and then, of course, some trading calls with the final minutes of trade.
Welcome back. Well, the markets try to fight back, but some bit of a downtake is what we're seeing the last few minutes. HCL Tech has moved a little bit lower. SBI Life, some of these life insurance companies have been under pressure, and the IT index as well is under some pressure. But we've just got 25 minutes on before we get into the weekend. It's a good time to find out what's going on in the dealing rooms in our special segment, D-Street Chatter. Well, Nimesh, tell us, what are you picking up?
Hi, Nigel. It's a mirror of what happened yesterday as well. The last 1 hour of trade, and we saw a bit of selling pressure, and that's panning out in today's trade as well. But like I said yesterday as well, there is no big panic selling. That seems to be the trend today as well. So the flows are mixed, but with a positive bias. But I guess today's numbers will get skewed because of the large two blocks, right? The Kotak Mahindra block of nearly 1.6% equity change and 3 crore shares. So that's going to be a large block, $750 million. And there is a large block in CMS Info as well. So those two will have an impact on the institutional numbers, so to speak. I guess the sector of the day today is clearly the Nifty Bank. The financials have relatively outperformed in a weak market today, and there is buying interest as well from the larger institutions. I highlighted the Morgan Stanley note in the morning as well. They believe that the private bank stocks are in a sweet spot, and some of the small private banks will relatively outperform the PSU banks from here on. So maybe that's having an impact on the overall banking sector. But I guess technically that 18,400 to 18,800 seems to be the range that we are playing on for the last many days now. I guess from a trigger point of view, the Fed outcome next week and the progress on monsoon, these are the two important events to track as far as next week are concerned. But again, clearly a day of consolidation, but the flow seems to be still positive from the larger FIs.
Okay, all right. Still broadly positive, which is good. You're taking some money off the table, I guess, par for the course. But Nimesh, tell us, individual stocks, what are you picking up?
So in terms of individual names, the first stock on my list is Manappuram Finance. Though the stock is in the F&O band, huge volumes in the cash market, and I believe some large FI seems to be buyer in Manappuram Finance. In fact, a leading domestic venture fund has recently added the stock as well into the fund, and they've been active buyer as well. So there is delivery happening, delivery-based buying happening in Manappuram Finance of late. So that's the first one. The second stock is Varun Beverages. For the second day running, I understand there are strong sell flows at a leading FI. So at these high levels, some bit of profit booking seems to be in Varun Beverages. The third stock is Tech Mahindra. Within the IT names, this stands out today on the sell side. Huge selling flow is what I understand from the dealing room. So the delivery volumes are going to be quite high in Tech Mahindra in today's trade. And the last stock is CMS Info Systems. In the middle of the trade, there is a very large block, nearly 14% equity has changed hands. I believe in terms of seller, the promoter entity, which is Barings Private Equity, they are the likely seller in today's block, and some marquee domestic funds are expected to be buyers. So the disclosures could be quite important as far as CMS Info is concerned.
Okay, thank you very much for that. In fact, CMS Info is a stock on our radar because it witnessed a very large block trade earlier today, 14% equity changed hands. And as Nimesh was just telling us, and what he's learned from his sources, that the promoter entity, Barings PE, was the likely seller in today's block, and a few marquee domestic funds were the buyers. Earlier today, CMS Info management spoke with the channel. Listen to excerpts from that conversation.
We had given a directional sense of our FY 21-25 growth prospects, and we guided towards a 2,500 or 2,700 crore revenue, which is almost a doubling of the revenue over a 4-year period. As of now, midpoint, we're on track, and we just held our investor meeting, and we updated our investors in terms of how we aspire from the next 4-year journey from here on. I think from a growth perspective, we will look at spending money for growth capex and also M&A. M&A would be in meaningful expansion in the logistics side of the business and also the technology side, as you said.
If you guys were straining to hear whether we spoke to the management about this plans to sell stake today, no.
Because the block deal happened after you had the conversation on Bazaar.
But 14%. So as you said, Rima, the Barings is the promoter. And of course, I mean, the CEO, I'm assuming, is the promoter appointee. Yeah. But, these things happen. We didn't ask, they didn't say, I guess. Well, that's the way to look at it.
Trade happened later. So, maybe we'll get them back again to talk about the plans. There is a large chunk of equity that's moved around. The belief is that it could be Barings, which is the seller. But for the time being, let's get back to the market and some more trading calls. Kush is back with us. Kush, so it's not changing much, right? Last I checked, 70 down on the Nifty. So it's a day of declines. What's the final advice and final trades then?
Sticking to the buy on dips theme, I think a couple of stocks would still fall under the BTST category. No SCBTs today for me. The first one is RBL Bank. This stock has given a breakout after a very long underperformance and is gaining from strength to strength. So I would suggest RBL Bank, a BTST buy. 180 and 184 would be my targets. The stop loss at 172. The other is the big one from the capital goods space, which is L&T. Similar story, with this stock for the past 5 sessions, the stock has been doing rather well. 2350 was a gap resistance which is filled today, and the stock is maintained. So almost agnostic of what's happening in the market. So 2400 and 2440 is my target. Are my targets on L&T. 2320 is where I would place the stop loss.
Okay, Kush, thank you very much for that. We'll slip into a very short break. We'll come back with more.
Welcome back. Well, the market's at the low point of the day, but the stock that's been the real outperformer this week has been Torrent Power. Just take a look at what happened. Someone would have thought that it's going to have an off day, and that seemed to be the case. But in the last 10 to 15 minutes, Torrent Power has moved one way. That's northward. Let's find out what's the call on the stock from these levels. Sudeep Bandyopadhyay joins us. Hi, Sudeep. Thanks so much for speaking to us. What's your view on the power space as well as Torrent Power in particular? For this week itself, the stock is up more than 20% post that big announcement that they made. Your take?
Nigel, good afternoon. I think overall power sector, we have been positive for quite some time, and we believe that the recent developments in this particular sector, especially the focus on the new energy, which is wind and solar, has done wonders for the companies in this space. And Torrent Power, obviously, on the back of multiple other operational parameters, have performed well. And that's why there is an excitement in this particular counter. But what we have been advising investors is to focus on the leaders in the industry. And we've been advising investors to acquire NTPC, even at current level. We believe it's better to go with the leader. Also, NTPC has made significant strides in the green energy space. There has to be a value unlocking there at some point in time. And I think investors will do well to buy into that. Of course, Tata Power also has recently kind of focused in a big way on green energy, and their order win from Tata Steel in this matter can be noted, and that also is going to be a significant beneficiary of the green energy initiative.
Okay, that's Torrent Power that Nigel spotted. Actually, quite a few interesting stocks are hitting the headlines. Now look at HBL Power Systems. Stock is up 8% as I see it right now on my screen. It's suddenly taken off. Remember, this is a stock we were speaking about at the start of the week as well. We started with that very unfortunate train accident. Now, this is a company that is into safety signaling systems, not just for the railways, for I think a bunch of other sectors as well. But it is into safety systems, and it's expected to be a beneficiary of more spends on those safety protocols and procedures. 8% up, so that's a big mover. Titagarh Wagons is up 7%. Paytm is up 6%. Sula is up 5%. So yes, there is a bit of a party in the mid-cap market for sure.
And Friday favorites, right? United Spirits, Delta Corp. Pull up the intraday chart. They're actually moving up,
Just reminding everybody that we are on a Friday and just, about 7-8 minutes away from the close. So Deep, hi, good afternoon. So let's get your thoughts on Paytm in specific, because there was a brokerage note, I think it was Bank of America earlier in the week, saying that the story is looking good now. The whole path to profitability is working out. But I think more importantly, the interpretation from the RBI's announcements yesterday on this, fintechs and the first loss guarantee rules that they're coming out with, that Paytm will be basically a beneficiary. What's your reading? I mean, it's had a great run. 800 plus on Paytm as we see it now.
Absolutely, Surabhi. I think this clarification from RBI on FLTG is a welcome development. There was a lot of confusion, and in fact, some of the NBFCs got pulled up for this FLTG matter earlier because the rules were not there, and in fact, it was against the RBI norm accepting FLTG and giving FLTG. So this clarification, will help definitely fintechs and a whole lot of other smaller NBFCs who are working in partnership with banks as well as larger NBFCs. That goes without saying. As far as Paytm specifically is concerned, I think, of course, the recent developments have been extremely positive. And I must say that, at some stage during their journey post-listing, they have realized and they are fully well cognizant of the fact that listed markets only recognize profit and path to profitability. Those other esoteric terms like the GMVs of the world or the volume of business of the world and things like that doesn't really matter too much as far as investors and analysts in the market are concerned. So that focus has brought in a lot of change. But I would, still hold back my views on Paytm and would not probably go and recommend a buy there. I think there is still some distance as far as profitability and sustainable profitability metrics is concerned. So we will wait and watch the developments in this counter, but not recommend a buy yet.
Sudeep, wanted to get your views on Voltas. We know the company has been losing market share given the huge increase in competitive pressures across domestic and MNC players. And I was reading an Ambit note, it came out a couple of days ago, and they don't believe this competitive pressure is going to ease because players like Daikin, LG are investing very aggressively. And they just put forth one number, which is quite telling. So they're saying Voltas's manufacturing capex is likely to be about 350 to 450 crore rupee. But this compares with 1,000 crore of capex by Daikin. So in that sense, these companies, competitors are really ramping up their presence in India, and competition is going to remain hot. Your thoughts on Voltas and the medium-term picture?
Well, Riva, I think, as far as Voltas is concerned, it is an avoid. Yes, they're losing market share, but beyond that, the margin is also under significant pressure. I think we haven't seen any significant progress on the margin front as well. Yes, you're absolutely right. The competitive intensity will only go up. But the way we read it, the competitive intensity is high as far as larger instruments, larger air conditioning projects, as well as in the metros and mini metros. Voltas has a wide distribution reach, and with the kind of smaller ticket, the products which they have, but smaller ticket air conditioners which they have, they can penetrate and they can gain market share in semi-urban and even rural markets, which unfortunately hasn't happened the way it was expected. And that is where the challenge is as far as Voltas. I think they need to go deep in the market. They need to find alternate markets to effectively increase margin as well as increase market share. And that's not really happening. And that's unfortunate. So I will hold back, and I will not recommend buy or anything in Voltas.
Any thoughts on IEX? Today is taking a bit of a hammering. Last 2 days, actually, Sudeep.
Prashant, you're talking about IEX?
Yeah.
I think, unfortunately, the regulatory challenges there are too much. This coupling of orders probably, kills the model. The price discovery, which was happening in the exchanges, will stop happening. There are some clarifications which are being sought. The management views I heard on your channel, but I think there's too much of regulatory uncertainty and too much of conflicting viewpoints. In any case, performance of IEX was nothing great. Even before this development of CERC, they were coming down, and there were a lot of negative brokerage reports. And I think with this happening, there is still more confusion which has been added to the problem. I will definitely advise investors to stay away. Don't even try to buy while it is falling sharply. No point catching the falling knife.
Okay, well, point taken, Sudeep. Thanks very much for joining us. We're just wrapping down for the day. Just 3 minutes to go for close. So the Nifty will end down 69 points, 70 points. Not at the day's low, but pretty close to it. Banks also ending, had a better day as compared to the Nifty, but off the highs. Mid caps and small caps, I think flattish kind of day for those indices. For the week, by the way, I was just looking at the small cap index. It is up about 1.25%. The mid cap index is higher, a little less than that. Nifty and Bank Nifty are also higher, green, Friday to Friday, even though things did moderate a little bit as we got into the last 2 days of this week, yesterday and today. A little bit of pullback is what we've seen. Rima.
The week belonged to Axis Bank, the day and the week. So Axis Bank ends with a gain of 1.5%. For the week, it's up 5.5% and at a fresh lifetime high. Innocent Bank giving it company today on the way up. Innocent Bank gaining close to about 2%. Power names had a very active and an up session. So Power Grid up 1% for the week. It's up close to about 4%. L&T did well. You had strength in DRL and Cipla. So a couple of these pharma names chipped in on the way up. On the losing side, Hero MotoCorp, Eicher Motors lost ground. Tata Steel under pressure, HDFC Life. In fact, the entire life insurance pocket was a bit subdued in trade. IT was weak. HCL Tech was down close to about 1.5%. And pull up Tech Mahindra as well. Tech Mahindra at the beginning of the trading session was under severe pressure, but I think it managed to recover a tad bit towards the close of trade, because right now it's only down about 0.8%. But technology for the week, the Nifty IT index is down 3%.
Yes, some selling coming back in the IT part of the market for sure. Mid caps, the index is subdued, but lots of high flyers. Take a look at a stock like Greenlam. The company has started operations at its new plant in Tamil Nadu, 20% up on that stock. Look at Hindustan Aeronautics, which has announced a stock split that will take place on the 27th of June. 6% up on HAL. Paytm 5.5% on the higher side. I could just go on. Long list of gainers today, actually. India Cements, very strong show, almost 7% up today. You've got some of the other names like Sula, which were gaining ground. So overall, a pretty good session for the mid-cap market. If you have to just, go beneath the surface a bit, go beneath the headlines. On the losing side, one and only one stock really stands out, and that has to be IEX, down 10% today, taking the total price damage to almost 20% in just a matter of 24 hours. A big story there on the power exchange side with regulatory fears coming in. But all in all, we're seeing the final close coming through. There goes the bell. 66 down on the Nifty and a close around the 18,560 level. So all-time highs, we'll have to wait for another day, another week.
Okay, with that, it's a wrap and closing bell. Don't go anywhere. Our Friday special, Smart Money, comes up next.